Hey, hello, and good afternoon, everybody. Welcome to today's workshop. My name is Jason Hamilton. I'm a certified financial planner and the founder of Keep It Simple Financial Planning. And I'm also the admin of this group, so I do my best to come every week and not only answer questions and respond to your inquiries inside the group here, but also to bring you some workshops that go a little bit deeper than I can possibly cover in any one particular Facebook post. So I want to welcome you today, and thank you for joining, and hopefully I can bring you some value today. If you didn't catch our workshop last week, we did a workshop on the updates that you can expect from Biden's new tax plan. So these are things that I really think you should go back and watch, because we're going to be basically building on top of what we talk about each week. So the next few weeks, we're going to talk about the general subject is taxes and retirement, but along with taxes comes distributions, right? So as you're distributing from your accounts, there's going to be tax implications of those distributions. And so the order you withdraw, where you take your withdrawals from, and things of that nature are going to impact that. So we want to talk about today a sequence of returns risk, okay? So for those of you who never heard about this subject, this is something that's very important. And actually, it gets even more important as you get into later in retirement, especially in the years of when you have to take required minimum distributions. So for most of you, if you are not already taking distributions, the age you're going to have to take distributions is at from your pre-tax retirement accounts is going to be 72. Okay, so sequence of returns risk is something that gets really important when you're forced to take distributions, because if the market's down, for example, and you have to take a distribution from your account, that could be really detrimental to your long-term portfolio success. And honestly, this is something that the government is very aware of, by the way. If you didn't know, last year in 2020, the government allowed retirees to skip their required minimum distribution that they were supposed to take in 2020. That's because the government knows that if the market's down, because it was down from the coronavirus, and if the market's down and you have to withdraw out of your account, this can be supremely impactful, to the long-term success of your portfolio. So I'm going to talk to you today about that. We're going to go into some examples of it, and then I'm going to show you a philosophy that we have on how to approach and essentially eliminate sequence of returns risk. So for those of you, again, that are just joining, I want to welcome you. And if you have any questions along the way, go ahead and put those in the chat box, and I will do my best to get those answered before we wrap up for today. Okay, so we're going to jump into today's workshop here. Let me just jump over and get this pulled up. All right. Okay. So today we're going to talk about what is sequence of returns risk, and we're going to talk about what it could possibly look like for you and your portfolio in the future. So I want to make sure that you are doing your best to prepare for this and avoid this if possible, because we're just in a really odd time. We really are in an odd time. We are expecting potentially a doubling of the minimum wage by 2025. So that could be crazy impactful to the market overall. I really hope that doesn't go through. Increases are one thing, but going from, I think it's in the $7.25 or $7.75 range to $15, especially in places like the Midwest, for example, is going to be, I think that's going to impact the market. I really do. And then the printing, seems to be, endless printing of money. In 2020, we printed just about $4 trillion. There's another package in the process of being passed right now. It could be another $1.9 trillion. And to be honest, we're just not producing enough right now as a country, with everything still somewhat shut down, to keep up with this. So these are some real concerns and things you really need to think about. And then on top of that, we have interest rates at basically zero. Right, so a lot of times in the past, you could just have some CDs or even a high interest savings or checking account and just live off the interest of that for a few years, and not really, I should say not really, but have a smaller impact potentially on sequence of returns risk. But now with bonds expecting to pay basically near zero for the foreseeable future, this is a really challenging subject. So there was a post made in here yesterday, I believe it was, about, hey, I don't understand why I need a financial advisor in retirement. I'm going to basically hopefully be showing you some examples of why you should get some advice, whether it's from me or someone else, but you definitely want to get somebody who specializes in retirement and ideally is at least a certified financial planner somewhere, some sort of good designation there that can help you out with this, because when you're in pre-retirement, I don't think it's that big a deal, because you are accumulating. So obviously there's things we can help out with, but when you go to retirement, these next few weeks, please watch along, because I'm gonna show you some things, some examples here that there's potentially very small things that you could do that can have a huge impact negatively if you get them wrong in retirement. So this week, I'm going to start with sequence of returns risk, and then we'll get into some more tax discussion ongoing from here. Okay, so before we jump in, I just have to let you know this here presentation and workshop is for educational purposes. So this is not meant to be particular advice for your situation. No tax, legal, or investment advice is being given. It is informational. Okay, so what is sequence of returns risk? Has anybody heard of this? So anybody that's watching live right now, if you can let me know if you've actually heard of this term, sequence of returns risk. I would love to know from you if this is something that you're familiar with. So sequence of returns risk, what it is essentially it's the danger of timing your withdrawals from a retirement account that will have a negative impact on the overall rate of return available to the investor. Okay, so this can have a significant impact on a retiree who depends on the income from a lifetime of investing is no longer contributing to your capital that could offset losses. So as you'll be able to see, I'm going to show you a few examples here. If you're still in accumulation phase, this is not nearly as big of a deal. But once you go to distribution phase and you are relying on your portfolio solely for income, or in addition solely, let's say you have Social Security or a pension, but if you need the withdrawals from your portfolio to cover your income, sequence of returns risk is something that you really want to be aware of and I would say take it seriously. Okay, so let's talk about sequence of returns during the accumulation phase. So what does this mean? Essentially, sequence of returns is what order you get your returns. Okay. So what we're going to talk about here is over a 10-year period. We're going to start with an initial deposit of $100,000 and have a 6% average return, okay? And this is with no withdrawals. So in this case, we are going to have some great returns at the beginning of our accumulation phase here. So as you can see, years 1 and years 2 out of 10, the first year we have a $30,000 annual gain, which gives us an ending value of $130,000. And the second year we have a 20% gain on that $130,000, which is going to give us an additional $26,000. So at the end of year 2, we're looking at $156,000. And then the next 6 years, we return 10%. And then the final 2 years of this 10-year period, we have a negative return. Okay, so we'll have a negative return of 20% the 1 year and 30%. So essentially, the first 2 years of positive returns and the last 2 years of negative returns essentially wipe each other out. And so what we end up doing is just taking the 6 years of 10% returns, which is a 60% return, divided by 10 years, and that's how we get a 6% average return. So essentially, positive returns at the beginning, negative returns at the end of this 10-year period, and we end up with about $154,764. Okay, so this is during accumulation. We're not taking anything out here, so the money just got to sit, and we didn't have to move anything around. Okay, now we're going to look at the opposite. Okay, where we have negative returns at the beginning. So we started with $100,000. So our first year, we had a negative 30% return, which gave us an annual loss of $30,000, which brought us down to $70,000 in our account. At the end of year 2, we had a 20% negative return, which gave us an additional $14,000 of loss. So now we're down to $56,000 in our account. But then the next 6 years, we had 10% returns average. And the final 2 years, we had a 20% and a 30% return. We had great returns there. So look what happened. Essentially, we had no difference in the outcome of our portfolio because we're during the accumulation phase and we just got to leave the money alone. Okay. So this is the importance for those of you that want to be market timers and move your money in and out of the markets. Generally, it's better to just either let the money sit or rebalance your account or something like that. But trying to move your money in and out of the market as there's ups and downs in there. If you leave it alone and things work out, then generally you're going to come back even. But if you take it out the wrong time, like imagine if you took out in year 2 your $56,000 and you took it out for the next few years and you missed those 10% returns, that really would have impacted you on the long term. But the big takeaway here is sequence of returns doesn't really matter during the accumulation phase. So if you're pre-retirement, you're still accumulating, not really that big a deal, okay? We end up basically at the same place. So if we had the same returns, just opposite beginning versus end, where the good and the bad returns were, we come out in the same place. So not really a big deal to consider. But most of you here are in the process of transitioning to retirement, and you are possibly in the next few years going to need to withdraw from your accounts, okay? So let's talk about an example of during the distribution phase, okay? So in this case, we're going to look at having an initial deposit of $100,000 and an average return again of 6%, so same order of returns we showed before. But this time, we're going to take an annual withdrawal of $6,000 from our account, okay? And this could be those of you, if you want to add a zero on the end, it's $1 million account, but the point will, it's really the same point at the end. So if you look at, in this case, when we have the good returns in the first few years, things, look pretty good. We start off well, and then we go through the next 6 years getting 10%. And then we have our bad returns the last 2 years of our 10-year period here. So essentially, again, we're getting a 6% return, but we're also drawing out $6,000 at the same time each year because we're in our distribution phase. So in this case, if we had our good returns at the beginning of our distribution phase here, then we would end up with, really more money than we started with, even though the last 2 years had a negative 20 and a negative 30% return. So that wouldn't be as bad. But if we flip this around, and again, we have over this 10-year period an average 6% return, but this time we're withdrawing $6,000 out per year, but we have our negative returns at the beginning, okay, instead of at the end. Look what happens here. By the time we get to our the end of our portfolio, our period here of 10 years, even though we still had the exact same average returns of 6%, but we had our down years at the beginning and our up years at the end, look at our ending portfolio. It went from over $105,000 down to $38,898. Same average returns, same time period. It's just a matter of what order the returns happened, right? So negative first versus positive second had a much bigger effect than having positive first and negative second, okay? So I want to pause here and see if there's any questions about this and if this is all making sense so far. Please let me know in the comments. And it looks like here, most of you have heard of sequence of returns risk, but a few have not. So for those of you that haven't, then this will be hopefully good to you and enlightening. So I'm not seeing any questions come in, so I'm going to move on here. Okay, so in this distribution phase, you can see here that the sequence of returns has had a big impact, much larger impact during the distribution phase than it would in the accumulation phase. Okay, so the difference here is quite stunning. So again, sometimes the numbers don't always impact you, so let's add a zero on the end. So let's say you started with $1 million at the beginning of your distribution phase, and if the returns were in the positive first and ended negative, you'll still have over $1 million at the end of 10 years. If the returns were negative in the beginning and then positive at the end, even though they're both 6%, your $1 million would be down at $380,000. So in this case, we're using 105 and 38,000. So this is what happens, and this is what can happen, I should say, depending on the order of the returns you receive in retirement. So what I want you to take away from today is you really want to protect against this and make sure you have a good plan to do this. And so, things like, having all of your money in just one big bucket is usually not the best idea, because if you have everything in one big bucket and just one portfolio throughout the whole retirement phase, like you did pre-retirement, then you can end up in a spot here where you end up possibly having some trouble with the sequence of returns. So we like to take a different philosophy, and this is how we look at this. Okay, but losing money in the early years of retirement can really hurt you. So if the market's down and you need to withdraw, this can be really bad. And then on top of this, if you're in the required minimum distribution phase, you're going to be forced to take money out. Right? If you don't take money out, you basically have the most severe penalty that the IRS implements, which is a 50% penalty if you don't take out your required minimum distribution. So if this happens during your required minimum distribution years, this can be really detrimental to your overall success of your portfolio, because maybe the government allows you to skip the RMD, but maybe they don't. So these are things that are very, very important, and investing in retirement is different. It's a different philosophy. Unless you don't need the money, okay? If you have all your needs covered by, let's say, fixed income through annuities, pensions, or Social Security, and you don't need to touch the money at all and you can leave it alone if the market's down, this probably won't affect you as bad. But if you're somebody who needs to withdraw from your portfolio, then this is something that should be really important to you, okay? So I want to talk to you about a strategy to help manage the risks and how we think about managing sequence of returns risk. So something really important is looking at time in the market, okay, versus timing the market. So there's a lot of folks that I've seen in our group here make comments about, their advisors tell them to get in and out of the market at certain times, or they're moving all the cash because they heard the coronavirus was coming, or 2008, they moved in and out. And I'm not saying you can never predict that this is going to happen, but to be honest, no one's been able to do it consistently over time. And the thing is, you have to get really lucky, right? And not only do you have to be lucky once by getting it out of the market at the same time, you also have to be lucky twice by going back into the market at the same time. And as we saw back in March of last year, from February to March, when the market dropped down over 30%, it shot back up in the next 30 days. And if you would have missed out on that, you really would have missed out on basically all the growth there. So when we talk about time in the market, I want to show you an example here of the S&P 500 index and what it's done if you look at rolling annual returns from 1926 through 2017. So if we look at this whole period here, which is just under about 90 years or so, just over 90 years, on average, the S&P 500 is going to be positive over any 1 year, 75% of the time, and it's going to have a negative return 25% of the time. Okay, so 1 in 4 years, you can expect to have a negative return in your accounts. So if you go back to what we were just discussing over a 10-year period, well, there's a very good chance over a 10-year period you're going to have at least 2 years that are down. But the question is, what years are they going to be, right? So as we saw previously, if they're at the end of your 10-year periods, they're going to have a lot less impact than they will at the beginning. But we really don't know that. I mean, there's no way to legitimately predict this consistently. But if you go to 5-year periods, about 88% of the time, over 5-year periods, the market's going to have a positive return. And a negative return would be about 12%. So as we go out further, it's a lot more consistent. So out of that 10-year period, you might have 1 to 2, over that time, versus, having about 9 or so average over 5-year periods, rolling periods. And if we go to 10 years, we have a 95% positive versus a 5% negative. And then anything 15 years or more, we've actually never had a 15-year negative return with the S&P, okay? So what I want you to take away from this is that you really shouldn't be thinking about trying to time the market. You should really be thinking about time in the market, okay? But the challenge is if you're withdrawing from your portfolio, you might need money today, right? So if you are using your retirement savings to fund your basic lifestyle needs, you might not be able to wait 10 years for the market to come back if you have to fund your retirement today. So I want to talk to you about a philosophy we use and how we set up things for clients, and give you some insight on how to essentially eliminate the sequence of returns risk. Okay, so this is how we look at it. When we are designing retirement portfolios, we like to segment up the assets. Okay, we call it our income conductor strategy. And how we look at it is any money that you're going to need in the early years of retirement, we want to keep that money either with no market risk or very, very conservative risk. So if you look at the segments, in this case, we have 5 segments. So if you wanted to think about those each as 5 years, a piece, and you can say, a standard 25-year retirement period, each of those segments is going to have a different investment strategy that is going to be employing a specific strategy for a specific return that we're trying to achieve. And so we're going to have different goals for each of those portfolios along the way. And so what this allows us to do is look at and look at your overall long-term projections for your income needs and what it's going to take for you to make it to the end of retirement without running out of money, and then design different segments with different strategies that will help you put yourself in the best position to meet those goals long-term. And we're able to see very early if we're off track or on track. And so we can track this each year and really look at how our retirement income portfolios are producing the income and the growth that we need. And if they're off, then we may need to make some changes. But if we're ahead, then what this can do is actually allow you to spend more a little bit early in retirement when you're more active. So this is why I don't really like the 4% rule very much, because you basically have just as much chance of your portfolio doubling by the end of retirement as you do ending up with 5% of what you started with. So it's just really, it's really limiting in a sense to what you can enjoy out of your portfolio. And it's been shown through many studies that having a dynamic strategy, a dynamic distribution strategy like this, where you might be taking more in better years and less in more lean years, has allowed you to spend at least 14% more of your savings over time versus sticking to something like the 4% rule. And then you have other folks now that are, saying you need to keep it at 3%. So, these are things that you can really limit your ability to enjoy life early while you're active if you're just sticking so strict to one of these particular strategies. So how I want you to look at it is thinking about the different time periods in retirement. And what we do is help clients design a really like a year-by-year strategy of how much can we safely spend on vacations, what goals do we have coming, when do you have to replace your cars, when we might need a new roof. Do you have money you want to give away to kids for, weddings, for things like that? Do you want to do gifting strategies, just along the way, just to give and to maybe your local church or nonprofits that are important to you? So these are all things that need to come in to your retirement income strategy. But then once you have that design, well, now we can start to set this up in a way to where we segment your assets up so that we are guaranteeing we're having the money we need today. And then with inflation being something that I think is a very big concern with all the money we're printing, we're also going to have our later segments that are in growth assets that are going to be growing for us, that are outpacing inflation, so that we don't lose the value of our spending power over the next 10, 15, or 20 years, which, in reality, there's two ways for the government to make up all this extra spending that they're doing. One is going to be through the front door, which is increasing taxation. Two is going to be through the back door, which is through inflation and just inflating the cost of goods and essentially eroding the buying power of your dollars. So I truly believe everybody needs to have some sort of growth assets over time just to counteract this. But how much in which bucket is going to be individualized. So the way we look at this is, each strategy here over time is going to be guided by a different rate of return. And then segment one is where your retirement income is going to flow. So we're always going to have at least, let's say, 2 to 5 years, maybe even 10 years of money that is 100% safe, that's going to provide the income that you need for you. Okay. And then segments 2, 3, 4, and 5 are going to be a little bit more increase in risk so that we can grow your assets over time. So by developing a strategy like this that has different buckets or different segments that are invested at different levels, you're essentially able to eliminate the sequence of returns risk, because if you have 5 or 10 years of money that's sitting in guaranteed type of return assets, and then that's there, well, you don't really have to worry about taking money out of any sort of growth assets when the market is down. Okay, so when assets in the first segment are exhausted, then the next segment is converted to the retirement income segment, and then all remaining segments stay true to their original investment strategy. So we essentially just move down the buckets to make sure that we are staying on a proper track for your growth and income needs over time. So let me see here. There's a good question here. So actually, we'll talk about that in a second. So this is where we're looking at loss of principal risk of potentially losing when the market is down. by having money that we're not going to need to really touch, for maybe 10, 15, or 20 years in these different buckets that are in increasing equity type of buckets or increasing risk type of buckets, we're essentially going to also nearly eliminate the principal risk loss by maintaining our time in the market. Okay, and so we believe in investing globally, not only just in S&P, because the S&P from January 2000 to December 2009 returned a negative 0.95%. So that could be a very high risk if you just have everything in the S&P. So we believe in investing globally because there's just so many opportunities worldwide to have good returns over time. And in retirement, we believe it's much more important to have more consistent returns than trying to, let's say, go for big returns in one particular year. So, when we have a plan, it's created to manage the investment losses utilizing the time in the market rather than timing the market. Okay. So there's a good question that came up here about does risk tolerance come into play when deciding how much money goes into each segment? I would say yes, a little bit, but more so it's going to be dependent on your income needs. Okay. So if we look at, let's say segments 4 and 5, where we don't need that money for maybe in this case 20 or 25 years, then we can be a lot more aggressive with that money because we really want to grow that money over time. And if we don't need it for 20 years, then if your risk tolerance can withstand it, then we can be even more aggressive with some of the investment choices we make there. So I would say yes to your question. Okay. So the big thing too is, when we look at inflation risk, having growth portfolios can really increase the probability that inflationary increases happen with your income. So, let's say you need $5,000 per month today to be comfortable. Well, in 15 years, that might be more like $7,000 or $7,500 to maintain the same lifestyle. So just by leaving everything in cash, you can see that if the costs go up over time, you really are going to draw down your portfolio much quicker if you try to maintain the same lifestyle. So this is where having those growth portfolios comes into play. And we generally make an assumption on the assumed rate of inflation. We never know exactly, but the government's target right now is 2%. But that's they're using some factors that incorporate things that may or may not affect your life, right? So your inflation may be higher than what the government's expecting on a whole. So these are things we need to take into account. Okay. Okay, and then, one thing as well that we find is there's a lot of folks that we work with that are expected to have more money than they may need to cover their basic needs. And so what we like to do as well sometimes is create an additional bucket or additional segment for longevity management with lifetime income. So these are things that you can do for, let's say you wanted to have some money set aside in case you had a long-term care expense in the future. Or you want to make sure that you are making sure that you can use that money potentially to purchase a long-term care insurance policy to make sure you have those funds there to cover yourself if you did live longer than you expect. So these are things that we can really create a plan for any length of time, but we as well want to make sure we create one that if you or your spouse lives an additional 5 or 10 years, that you're planning for that because that could be really detrimental if we don't. Okay. So there's also some really key things. There's some key importance of also managing this plan. This is not really a set it and forget it type of plan. And I would love to tell you that that's an easy way to just do it for your retirement, but in reality, it's just not really like that. You really have to be managing your plan throughout, because what you don't want to do is just hope everything works out and wake up at 82 and realize you're still very healthy and you're almost running out of money because you thought you were going to die at the average age of, let's say, 84 to 86 for men and women. So you got to manage this plan over time. And then as we're seeing today, really have to look at flexibility of the income and income segments. So I like to take the idea that we're going to review this every year. And if we're ahead of track on our plan, then let's put some more money down in the bucket one that you can spend and enjoy and give away and do the things that are important to you. And if you look back just a few years ago, it was pretty easy to get 2%, or 2 to 3% on some sort of fixed assets, even just a high interest savings account. But now that's not really the case. So we got to make sure we're preparing ahead and we have some flexibility in that income. And then we got to look at investment selections. It's a great question here that was asked about risk tolerance. We want to have a plan that makes sense, but we also want to make sure it makes sense for you and your risk tolerance. So choosing the right investments and the right mix of investments for each of your segments so that you can stay on track while also sleeping at night is very, very important. And then liquidity, okay? So we want to make sure we don't want to tie up too much in anything that's illiquid. So I know a lot of folks really love the idea of having guaranteed income. So annuities, some people really like. And I'm not 100% against annuities, but we want to make sure we're giving you the liquidity you need and that we can make adjustments over time. And if you have a product that you need to leave for 10 or 12 years that you can't draw out of, if you might need that, then we really got to make sure we're getting the right products for you and making sure that you can get out of those assets or get that to that money when you need it. And then the fourth thing is the ability to adapt to changes. Okay, so things are going to change. Go back to 2019. The world was looking a whole lot different than it has in 2020 and 2021 so far. So we need the ability to adapt to these changes and to potentially alter our strategies if needs be. So we want to make sure you're managing your plan, looking at it at least once or twice a year, and making the updates on this to make sure you're good. Okay. So hopefully this was helpful to you. I want to thank you for watching today, and I want to invite you, if you need help and if you want to talk about a potential plan for your retirement income strategy, I'd love to discuss that with you. This is what we do. This is how what we really specialize in. So if that's you and you like the idea of what we talked about today, and you want to set yourself up to help you prepare for the sequence of returns risk that you might be facing, then you can go to keepitsimplefinancial.com/talk. Once again, that's keepitsimplefinancial.com/talk. Okay. So let's pull up, I think there's some questions here. So if you have any questions, please put them in the chat right now, and I will go get to them as soon as I can here. All right, let's look at this here. So, and let me ask you, so was this useful? When you saw the sequence of returns, do you find this useful? Was this something you've really thought about? And did you think about like, hey, you can have two different situations that both average 6% return over 10 years, but the order of those returns and how it can impact you. Is that something you've ever thought of or you've ever gone through before? I'd like to know that. I'm going to put my website here while we have some questions. Okay. So question here is, should we have cash of 1 or 2 years expenses to help with potential downturn early? Cash is obviously very liquid, right? So cash can be a great place to just keep 1 or 2 years. But is that enough? Okay. That's what you have to figure out for yourself is that enough for you to weather whatever downturns you may face? And if you don't want to keep that much in cash because right now cash is just not paying a whole lot, well then what other strategies can you employ to help you earn a little bit more than you can in cash, but still give you the liquidity and that safety that we need for those early years? So that's the only question I'm seeing here so far. So good. It looks like a few people have not heard of this before. Good. So anyways, folks, if you'd like some help, love to help you out with that. Love to chat with you. These next few weeks, please be sure to tune in because I'm going to be building on everything that we've talked about so far. And so if you miss a week, then you're going to miss out on something. And so this is all going to be about taxes and retirement and tax planning and retirement. So sequence of returns is really the first step of, are you set up appropriately from a investment perspective to make sure that you have the money that you need and it's going to last throughout retirement. And then we got to talk about, now that we need to fund these segments, what do we need to think about when it comes to getting the right investments in the right buckets and which account to draw from, which order? What should we be thinking about when that comes to getting you set up for more of a retirement income type of investment plan? So hopefully you enjoyed this again. I appreciate you watching, and we'll see you next week. If you need any help, let me know. I'll put a link down as well in the comments if you want to just click through. Other than that, I'll wish you a happy Sunday, and we'll see you next week, folks, okay? Have a great one. Bye-bye now.